Hello, investors, and welcome to Stocks to Watch. I'm Ashley Berry and joined today by Don Durrett of goldstockdata.com, a firm known for its deep insights into macro trends and sector strategy across global markets. Don, obviously, you have such a great voice in this space, and it's wonderful to have you back with us, especially at such a pivotal moment for investors. So thanks for being here on Stocks to Watch, Don.
Yeah, thanks for having me back.
Absolutely. So, let's start with the Fed. Policymakers lowered rates in September and signaled that further cuts may be on the table later this year. So, given the current inflation picture, the employment situation, and really overall growth potential, do you think more cuts are warranted, or will the Fed take a wait and see approach? Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
I think the Fed is absolutely trapped here. There's nothing they can do to prevent a recession. They can try to cut rates. They can't cut rates uber aggressively because that'll create more inflation. The reason why gold has been ripping higher is because when he gave the Jackson Hole speech, and he basically said, we're going to pivot here, and we're going to stop fighting inflation, even though we haven't won the battle, and we're going to start focusing on the economy. And everybody realized that at that point, they really don't have a handle on this. Can they really prevent a recession? Can they really somehow control inflation when they're not going to fight it? And so gold's been ripping higher. But the backdrop of this is that the US economy has been deteriorating since the year 2000, 1999. The 1990s, the US economy kind of was able to generate enough growth on its own where we didn't need to have this uber, fiscal policy where the government has $2 trillion deficits. In 98 and 1999, we actually balanced our budget. The economy was standing on its own. And after the dot-com bubble burst, and then we had 9/11, we haven't been able to stand on our own. And it's just been getting worse and worse and worse. The Chinese recognized it in 2013. In 2013, they had about $1.5 trillion in our treasuries, and they were comfortable buying treasuries and accumulating treasuries. In 2013, they stopped. They've been net sellers since then. So they went from 1.5 trillion to about 750 billion today. And they're steady. So they were kind of way ahead of the curve, and they've done it very slowly. But now the rest of the world has kind of figured out what China figured out, that, it's not such a great thing to hold our debt. And so what people don't realize is that our economy has been slowly deteriorating. You can see it with the middle class. The middle class's standard of living is slowly getting worse and worse, where you can't afford a house anymore. The average buyer is now, I think, 55 years old or somewhere north of 55. Younger generation can't afford a house. It should be in the mid 30s, not the mid 50s. The reason why it's in the mid 50s is because parents are buying the houses and it's going under the parents' names. So the parents have the monies, but the kids don't have it. That's kind of an underlying theme, that America is not what it used to be. And they talk about this so-called, this U.S., kind of dominance because, we have the biggest corporations. We're the most innovators, but it's misleading. It's like, that's why we're top heavy. I have like this Mag 7 kind of, dominating the stock market. But it won't last much longer. Like I said, the Fed's trapped. They can't prevent a recession. So all we're doing right now is waiting for the recession. We're just waiting. Wall Street wants you because they're just going to spin it to make it look everything's fine. We're in a business cycle. We're never going to have another recession again. We haven't had a recession since 2008. We haven't fixed the business cycle. Some people say, well, it got reset in 2020. We had a recession in 2020. Well, the stock market didn't go down in 2020. And what world do you live in when you have a recession and the stock market doesn't go down? And where was the layoffs, right? The only layoffs were, people went and worked at home, but we didn't have a big, 8%, 9% unemployment rate where people were laid off. We didn't have that. So it wasn't a recession. We haven't had one. We're going to have one. That's my point. But the bad news is like I said, the Fed is kind of trapped here. They've always, since I don't know, my lifetime, the Fed has always been able to do what was necessary to, fix any recession.
Hmm.
Um, in 1979, 80, Volcker took the federal funds to 18%. He could do it. Because our economy was strong enough and resilient enough. He could do that. Today, we can't do that anymore. We can't afford it. That's how weak our economy has got. And so it's a really scary time, and that's the reason why, some people are saying, well, people are going to gold just because it's the latest trade. That's not why people are going to gold. They're going to gold because they're nervous.
Hmm.
You don't
Hmm.
buy gold because it's the latest trade.
Uh-huh.
I don't think. I think people are going to gold because they're nervous, and especially central banks. Central banks are like, okay, if the U.S. economy is going to go down, the U.S. economy is literally kind of the foundation of the global economy. And so if that's going to go down, then what's the impact of that? And so that's the reason why they're shifting away from U.S. Treasuries, which are going to lose value if the U.S. economy can't kind of reset itself, and going to gold. And I've been saying this. This is a transition point for America, and it's not going to be a fun one. I don't believe. I think right now everything is still normal, right? Everything is still normal. You need something, you go on Amazon and buy it, and it shows up the next day. It's just we still live in easy street. I call it easy street. We're still living on easy street, and we think that's going to continue. And gold is saying, be careful. It might not continue, and be ready for if it doesn't continue, what the outcome is.
Hmm. So with gold saying that and living on easy street, right now, do you see any particular industries that are, say, early movers in the next phase of the cycle, the doom and gloom, as you say? What should investors be paying attention to, be investing in? What's your recommendation to be kind of ahead of the game here?
They should be stacking gold and silver, even though gold's at 4,000, 4,100, 4,200 today. Even though gold's at 4,200 and silver's at
Amazing.
52, almost 53, they should be stacking physical metal. And the reason why is because that's the only asset that we can kind of depend on, if you will, of
Mm,
not going down 20, 30%. We've always talked about gold as a hedge. Well, guess what? We're there now. We're there. We finally got to that point when gold finally matters. It's
hmm.
the first time really in our history when it really does matter now.
Sure.
I've been saying the people that are going to buy gold and silver didn't think they were going to buy gold and silver. Like I never thought I was going to buy gold and silver. What the hell am I doing buying gold and silver? Those are the people who are going to be buying it because we've reached that. It's gotten to the point now where gold and silver actually finally kind of makes sense for the average person. It always made sense for the tin hat folks like me. It always made sense for us because we were always kind of paranoid of the future. But the average person who is always uber optimistic about America, that person even has to start stacking gold and silver. That's really, I mean, if you look, where are you going to invest your money? I actually think kind of the best place kind of looking to invest your money is actually internationally
Mm,
because you have emerging markets. So those economies will probably grow a little bit, whereas the U.S. stock market, when we go into bear market, it might last 10 years. It usually does.
mm,
Usually when we get a bear market, I mean, the last bear market went from 2000, all the way until like 2013. I mean, if you look at the S&P 500, it's kind of flat for 13 years. So expect that again. And then bonds, are you really going to go into bonds? If you go into bonds, you're probably going to lose money two ways. The first one is on the long end. The long end, it's probably interest rates are going to go up, so the value of bonds are going to go down. So the long end isn't going to work. And then on the short end, you're probably going to break even or lose money because of inflation.
right.
And so bonds aren't going to be a great place to hide. You're going to go put your money in cash. We're going to have 3, 4, 5% inflation here, average for the next few years. So you put it in cash, you're going to lose money there. So there's not a lot of places to hide, but gold and silver.
Yeah,
And some foreign investments, I think, probably going to work too.
yeah, a couple of the notes I just took down was stacking physical gold and silver, like you said, and international investments is the way to go as you see it now. As you said, gold prices are now even just today, as we talk, October 15th, pushed to more than 4,000 per ounce. Certainly an impressive move, 4,200, I believe. So let's talk about gold related names or miners that might be on your radar in this environment.
Yeah, so I've been posting a lot of lists. I give people, look at these stocks kind of thing on X. And then of course on my website. And,
Hmm.
I've been pointing out kind of the quality names. Basically go look at these stocks. I mentioned, coming out of Beaver Creek, I mentioned 26 names, I think.
Hmm.
So I've been giving people lots and lots of names to look at. And, I actually posted this week, stocks that you probably don't own enough of. On You guys can follow me on X, but I listed about 15 names of stocks that you probably don't own enough of. In other words, those are stocks that are probably going to go up a lot.
Hmm.
And those were all developers and producers that are going to grow production. I found my absolute favorite place to invest is a producer, an undervalued producer that's growing production. That's absolute favorite. And I learned that lesson really early in life. And it was First Majestic Silver. I bought it about $1.15. They said they were going to grow production to 12 million ounces, and the market was giving them a valuation of under 200 million. I'm like, and it was ridiculous. Keith Newmeyer, the CEO, goes, "What the heck's going on here? Don't you see what's coming down the pike?" And nobody would buy it. And then the
You
stock
did.
market crashed.
You
And
saw
then
it,
the stock
Don.
Right. So 2009, the stock market crashed and the silver miners crashed, and everybody was selling First Majestic and was going down, down, down. It's like
Mm.
they were ignoring that future production growth. So
Mhm.
as soon as things turned, that stock went from $1.15 to 25 in a little over 2 years.
Mm.
And so that was the lesson I learned. Is like, so if you can find an undervalued producer with production growth, because it's not priced in, those are the I found those are the absolute best risk reward stocks. So Avino Silver, they were showing 8, 9 million ounces of future production there, and then they were only at 2.5. So it was basically an identical story to First Majestic. And they had a market cap down like $70 million.
Mm.
And it got down sub 45 cents. And I said, buy this stock to the bottom. This is as cheap as it's getting, people. That stock today is $6.50. So it went from 40 cents, a little over 40 cents. It never got under 40. I think it got 42. So let's call it 45 cents. Today it's at $6.50. Heading, so not even close to done. Heading to $40 to $50. So
Mhm.
if it would have been a 100 bagger. If you would have bought it there at 45 cents, you would have got a 100 bagger out of it. That's the kind of leverage you get if you can find a producer that's undervalued. Now that 100 bagger is going to be in tandem with higher silver prices, but that's how I invest. I don't care about the current silver price. I don't invest for the next 12 months. And you shouldn't either. You should, and I got an email today. Somebody was telling me about two stocks that were lagging. And they were both development projects, and they neither are highly advanced. Those stocks aren't elastic.
Mm.
They're not going to work early in the cycle. The word stocks are going to work early in the cycle are the Heclas and the Coors and the Avenos, the stocks that have huge elasticity. Not the development projects that don't even have a path to production yet. But those projects will work, but 3 years down the road, you got to wait until they get advanced. So you want this elasticity.
Love
You want
that.
exposure to, and so those stocks that I listed, most of them were producers, but there were a lot of more developers with a strong path to production. So if you can find a developer with a strong path to production, those stocks are going to go up. And so those are my two favorite places to invest. I don't know why my nose is itching today.
Well, scratch it because I have another question for you. So I love that you said elasticity. So basically, it's elasticity coupled with patience, right? Because you're not investing for tomorrow. It's a year, two, three down the road. I mean, look at what you talked about with Avino Silver and how that turned around. I'd like to talk a little bit about, AI and, tech concentration risks. So tech AI trade powered much of the recent gains, you would say, but it's also created some concentration risk. So I guess, are you what is your view on AI at this point? And, sort of how it is driving this? And are you kind of rotating? Because I know you said you had, this is a big, long question, Don, but I want our investors to know that you have a list both on your Twitter, which I'm assuming it's your name, right? Don Durrett, on your
Yes.
X, and then also on your website, goldstockdata.com. So I just wanted to mention that because that's very important. But when I talk about that, I'm also asking about the rotation. And so do these lists, do they change based on certain things you're seeing, or do you think these are the ones that have the elasticity that you talk about?
Yeah, so there's two questions there. I'll answer them both. Let's start with AI. AI, in many respects, is actually in the short term is having a negative impact because it's reducing employment opportunities.
Hmm.
Amazon yesterday said they were going to lay off 15% of their HR department, and we've been hearing that AI is really good at finding candidates. So it's like, so and so and so basically they're eliminating AI. AI is eliminating jobs, and
Mm.
so and in the near term, it's actually somewhat of a negative, if you will, for the economy.
Hmm.
Um, it's it's hard to down the road, what the impact's going to be in a positive, negative manner. But economically, I think it's kind of moving us to a 4-day work week where we don't need as many workers. I always wanted a 4-day work week. So I think that's where I think AI is going to lead to a 4-day work week. I think that's one of the trends. Okay, let's switch to rotation.
Hmm.
So the one thing that I don't want to do, I've learned this lesson, is I don't want to take profits early. I think you make your money when you buy, and that's getting a good entry, and you make money when you sell, and that's getting a good price. And if you sell early, you're not getting you're not making a smart move, I don't think, because you're giving away money. It's like so you have to we are speculating in gold, silver miner stocks. And so if we're speculating, then you're taking a little bit more risk. We're not investors. So the average investor is trying to make annual returns. So he's always like take a little profit here, and he's basically trying to get his 20 to 30% annual return. And so you're moving money around. Okay, I'm up 100% here. Well, my goal here is to make like 30% a year. So let's take 50% off of that. Investing is really all about rotating. It's a big thing. Some people are buy and hold, but the average person, a lot of people are kind of when they make big money, they like to rotate, they like to take profits. But in speculating, you're trying to kind of maximize your returns, buy low, sell high, sell as high as you can. And I learned a couple lessons I learned. One of the lessons I learned is that exploration stocks have terrible risk reward. I learned that one very early because you buy an exploration stock, if it doesn't work, it just crashes. You just get killed. So I learned that lesson. Whoa, 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 what's going on here? I didn't know these exploration stocks are so volatile.
Hmm.
And the second lesson that I learned, significant one, was if you take profits early, you give up a lot.
Hmm.
I want my shares back. Why did I sell those things? So if you take 50%, if
Hmm.
you let's say a stock doubles and you take 50% of it, you sell 50%, you just gave away 50% of your upside.
Hmm.
So if it was going to be a 10 bagger, you only have a 5 bagger.
Right.
So I'm like, give me those shares back. And because my belief is stocks are going a lot higher, so I don't want to sell early. So you have to figure out, when is early? Well, guess what? People have been taking profits in Avino at $2, at $3, at $4, and we're at 650, and it's heading to 40. It's heading to 40, and you're selling, so you're still selling. People have sold half their vino and they're like it gave away. It's like going when silver was like at $30 and you went to the store and you didn't need to sell your silver. You didn't need the money. And you
Mm.
went in there and said, here, take 1,000 ounces of my silver for $30. You were literally burning money. You were just throwing money away. It's the same with miners. If you sell early, you're just throwing money away.
Mhm.
And that's a lesson that I learned. So we know that gold is a monster here. We know that. We know that the $50 level for silver was a really important all-time high, that once you got above it, you're going a lot higher. You're not,
Mm-hmm.
and because gold is such a strong stock right now, the wind at gold's back, you're not going to see, the end of end of this move, if you will. So the reason why you take profits is because you're concerned that that stock might be topping out. Well, Vino's not topping out here, and these other stocks aren't topping out. We're early. So the first time to take a profit, I believe, and we haven't gotten there yet. We have to at least this market at least has to get mature before we even start thinking about a profit. I mean, we can look at several factors that aren't in play yet to show us that maturity.
Mm-hmm.
And we're not there yet. So, and I've been saying, let's wait till we get to $4,500 gold, and then we'll see if we're at maturity yet. We're at 4,200. We're not even there yet. So we get to 4,500, we might not even be there yet. So here are the things that have to happen before we get to maturity level. The first one is the full cash flow multiple, the free cash flow multiple. In 1980, the average, that was at the very top, it was 22. Today, I did it, I haven't checked lately, but I did it about, I don't know, a couple of months ago before August, it was at 7. The average in the producers was 7, which was just ridiculously low. At that time, I think Newmont was like an 8. Now it's probably a 10 or 11, but free cash flow has exploded for them. So it's probably, I don't think it's above 10, but it was like, Newmont was like an 8, and so was Barrick. I mean, these stocks were just ridiculously cheap. Agnico Eagle, which was the best stock, was like a 10. And so we need to get the average multiple above 15 before we even talk. So it's got to double the 14. So these stocks will have to double. Let's call it 13, 14, 15, somewhere in there. But the multiple has to appreciate significantly before we start thinking. Now, these stocks are undervalued. I'm talking about first we got to get to a legitimate valuation based on the margins. So we have gold margins today of around $2,000. I mean, it's kind of crazy.
Mm-hmm.
I think the last earnings season, it was like 1,350, 1,400 margins, but gold has exploded over the last quarter. So
Right.
now we're like, I don't know, 1,800, I haven't done the math, $1,800, $2,000 margins. So the margins are blown out, but guess what? The free cash flow multiples haven't. And so we have a ways to go here. We need to, first of all, these stocks need to be fairly valued, right? They're still cheap. So I think that, Newmont's at 93 today. I think it's got to go to, 120, and it's got to appreciate quickly. That multiple's got to expand.
Mm-hmm.
I mean, it at 110 is still going to be like 11, 12, and it's got to expand fairly quickly. I mean, if gold keeps going higher, then it has to outperform. So the miners, and the reason why these miners are so undervalued with these low multiples is because Wall Street's not involved yet.
Mm-hmm. Yet.
Wall Street, we got an all-time high in the stock market. It's up 14% for the year. The S&P is up 14% for the year. It's only down 1% from its all-time high.
Mm-hmm.
So people have been making money on Wall Street. They haven't rotated into the mining stocks. There's there's like nobody owns these things. It's like 0.01% less than that. But the average investor doesn't own any mining stocks. They don't own any. And the reason why they don't own any is because they're making money on Wall Street. If you're making 14% on your money, and last year you made 27, you're like, I don't need to rotate. I'm happy.
Mm-hmm.
And so that's the reason why these stocks are so cheap, because nobody's rotated into them, but they will.
Yeah.
Okay. So I mentioned the multiple that when until the multiple gets to, I don't know, 13, 14, 15, somewhere in there, that's fair value. We got to get to fair value before we even start thinking about maturity. And then we start getting into the mania phase, and you get to 18, 19, 20. And once we get to 18, you're pretty much in a mania. I don't know. I think we get to 18. I don't know if we'll get to 22 like 1980. We probably won't get to 22, but I think we'll get to 18. And so we got a ways to go here on the multiple on maturity levels. I mean, I don't think I'm going to be taking profits until we get to at least 12. So, we got to go up, maybe a little higher than that, which is, it's not a 50% move in Newmont, which would take it to about 135. But, when Newmont's around 120, 125, and then we can start maybe taking some profits. Maybe we'll have to wait. Okay, so you got the multiple expansion. That one, we have to wait for that. The second thing that we have to wait for is we have to wait, and I mentioned this earlier, we have to wait for Wall Street to get involved. So the only way Wall Street's going to get involved is if the stock market stops going higher. So we need about 3 months, at least 3 months of the stock market just, we need it to go down. First, we need to go down because that's what it will do, right? It'll go down. But after it goes down, then we need about 3 months of it not rotating back, not going back up. And that's when people give up. So if you get, I don't know where people are going to jump off the boat, but it'll be sub 5,500 on the S&P. So, we're at 60, almost 6,700. I say that we're going to go sub 6,000 in a blink. It won't take long to go sub 6,000. And now, but people will start jumping off the boat, I think, around sub 5,500 and definitely sub 5,000. So 5,500, 5,200, 5,000. Those are the three levels for me to watch for the rotation into the miners. So that's when the mania kind of kicks into gear, and that's when you have to see how much further does this thing have to run. So that's when you start taking profits, and then you have to kind of reassess and see how strong gold and silver actually are. They could actually be getting stronger, which is kind of bizarre. Because normally when these markets hit these tops and they get, RSI to the moon, normally that's when they crash and they roll over and die, normally. But guess what? If this US economy goes into recession and the Fed is trapped and can't basically rectify it, and the economy lingers and the stock market lingers, I mean, we're talking 6 months, 12 months, 18 months, gold could actually become even more attractive. And so then you're looking at gold going 5,000, 6,000, 7,000. That's a probability. So we need those three things before we hit maturity. So we need the multiple, and then we need the stock market to stop going up, and then we need Wall Street to basically participate, which is kind of the same thing. I think there was one other factor, but I can't think of it. But we're not to maturity yet, and so. But
so I would ask you, Don.
We're out of time. So
no. These are fantastic insights, Don. But in one sentence, if you can do this, what would you say to investors? What is your best piece of advice in one sentence right now, other than following your company?
That's easy peasy. I already said it. You need to stack, buy a safe, and start stacking every month. Decide what you want to stack. Do you want to stack silver? You want to stack gold? And don't think of it, oh, this stuff is too expensive, I can't afford it. Don't think that way. Think in terms of how much cash do you have? A percentage of that cash needs to be converted into gold and silver. You have to think in terms of a reset's coming. A possible reset is coming. I always tell some of the people I interview, I tell them, you're not paranoid enough. This last guy I talked to, he didn't own any gold and silver, didn't own any, but he had a huge portfolio.
Yeah,
you got this massive portfolio. You have no gold and silver. You're not paranoid enough. If you're paranoid, you'd own some. So you're not. You need to be nervous about the reset. The reset's coming. If the reset coming, you're going to get the fiat's going to get rug pulled. We're going to one morning we're going to wake up and our fiat's going to be down 30%. That's what a reset is, and you're going to lose 30% of your liquid fiat. So that's the easy piece of advice. But start stacking. I also said the best place to start is 1,000 ounces of silver. Just do 5-ounce, 10-ounce bars, and just start stacking every month till you get 1,000 ounces. And then once you get 1,000 ounces, you can decide: do I want more silver? Or do I want to pivot to gold now?
Okay, good advice. I always walk away from our interviews with so much extra knowledge in this space. So I so appreciate it. And for our viewers, You can follow Don Durrett on goldstockdata.com. Also on X, as we said, Don Durrett for most of his latest market analysis, sector commentary. But that is all the time we have for stocks to watch today. But stay tuned as we continue tracking the Fed's next steps, shifting sentiment in equities, and of course, hopefully opportunities across commodities and tech. And just listen to what Don had to say. So thank you all for watching. Thank you, Don. We'll see you next time.
Thanks.